Did you just check this side? So, because it's the way that is, that's for sure.
Hello. Contact FedEx.
Yeah. Oh my God. Okay, let me know if you ever see it. Okay. You think? Yeah, maybe. All right. All right, well, then I'll call you after my class and I assume it's still there. If it's not there, and if not, I'm not in question. Yeah, that's the problem. And I have a problem too after also. So. All right. Okay. Thank you. Let me know what you say.
Okay, it is 1:25. It's AC222 time. Okay, so we are going to pick up where we left off last class. So remember, we're talking about decentralized companies, these huge companies that no longer can let the CEO make all of the decisions. And so we are allowing middle managers to make decisions. And then we also have to make sure that we can hold them accountable for the decisions that they are making. So we talked about cost centers and profit centers already. Remember, a cost center is part of the company that provides a service to the company. And so therefore, I'm going to hold them accountable for controlling costs. Flexible budgets, great way to do that. Profit centers are usually your product line managers, and that they are responsible for your products. So it's bringing in revenue and controlling cost. And so we need to hold them accountable for bringing in revenue as well as controlling cost. Flexible budgets are good for that. And then last class, we also talked about segmented income statements again, right? So we looked at a segmented income statement, which also looks at the revenue that that segment is bringing in and just the expenses that are caused by that segment. Again, an excellent way to evaluate a profit center. And then we went into a little bit more detail about how we can take that segment and then continue to break it down further, watching for those traceable fixed expenses that might become common fixed expenses. All right, so today we're doing our last responsibility center, which is investment centers. So remember, investment centers are where we are going to evaluate our top management, usually the vice presidents of the entire division. And so that's what we're going to talk about today. Specifically, we're going to talk about return on investment, because vice presidents, remember, or the person that's in charge of the whole division is going to be responsible for everybody that works under them. They are going to be responsible for the profit center's revenue and expenses if they fall under their division. They are going to be responsible for the cost centers under their division, being able to control cost. But a big part of their job is to choose the right assets to help bring in net income. So when you're talking about return on investment, this is the way you're going to evaluate how well management is doing choosing assets. Remember, your assets, if you think about the balance sheet, are equal to your liabilities and your owner's equity. And so you are going to get money either from debt or equity, and then from there, you invest in assets. And your assets are what generate your sales. You use them to generate sales, and then eventually you get your profit or your net income. So this is an important part of top manager's job. So we're going to look at the return a manager earns on the assets, again, under their control, right? You can only evaluate a manager that has control of the assets that they are picking. So when I say return on is generally referring to your net operating income. I know you did some financial statement analysis last semester, return on equity, return on assets, right? Return on generally means that net income, that operating income. And the net operating income for return on investment is going to be compared to your operating assets in order to see how they are performing or bringing in net income. All right, so here is the return on investment calculation. ROA, ROI, those terms are interchangeable. Your assets are your investments. So whether it's shown as ROI or ROA, it is the exact same calculation. You're going to take your operating income or your segment margin, because we are evaluating, remember this whole chapter is talking about the Centex yarn and looking specifically at that nylon fiber division. So remember, we've already looked at nylon fiber, and originally they were concerned that it was showing $100,000 loss. But when we redid the segmented income statement, we saw that that was not true, right? When we set it up looking at direct and common fixed expenses, we did see that the nylon division was actually contributing a positive segment margin. So if I'm evaluating the company as a whole, then I'm going to use the net operating income. But I'm evaluating segments right here, so I'm going to use the segment margin, which is essentially the same thing, right? Net operating income, remember, if you're thinking about the income statement, that's your operating income before interest and before tax. So we are looking at the operating income. Why do we not include interest? Well, because you pay interest because you have debt, right? And I'm trying to evaluate how well a manager is doing choosing assets. If I include interest expense here, then I'm penalizing that manager for choosing or buying those assets with debt versus equity. And I don't want to do that. I want to analyze how well they are doing just choosing the asset. So I'm pulling out the interest, and then taxes is just a number that you calculate based on your net income. So I'm trying to look at how well the assets performed. Okay, so average operating income or segment margin is what we're going to use to evaluate a segment of the business, and you're going to divide that by your average operating assets. And average operating assets is what we want when we are comparing an income statement number to a balance sheet number. So when I'm looking at net operating income, this is from the income statement, and you have to remember the income statement is a collection of revenue and expenses over an entire period. So this would be the operating income over the entire period. Where your balance sheet, if you're comparing a balance sheet and an income statement number, your balance sheet is just saying on December 31st, this is what I have. So in order to get a more apples to apples comparison, you want the average balance sheet number. Take the beginning plus the ending balance and divide by 2. And that way you get a better idea of over the entire period, comparing it to the operating income over the entire period. The other thing I want to know about these average operating assets is that they should be your productive assets. So when I'm looking at productive assets, may not be every single asset I own. If I own a building, but I'm not using it myself to generate this income, I'm renting it out to somebody else, then that would not be a productive asset. I'm trying to figure out the income that is generated from the assets that I'm using to generate that income. Right, does that make sense? Okay. All right, so let's take a look at the ROI for our 3 divisions. So remember, we originally looked at our net loss of nylon fiber division, and we were concerned and we were thinking about getting rid of it, what we should do about it. But then when we restated that income statement in a proper segmented income statement, we saw that it has that positive segment margin. And we said, okay, we would not want to eliminate it because we know our net income would go down if we did. So I have a positive segment margin. And so I'm still going to further analyze these divisions. And when I look at ROI, basically what I'm looking at is how well these assets are doing generating net income. So here's your segment margin, right? Segment margin when you're evaluating the segment. And then here are your average assets. And you can see when you're comparing the ROI to the 3 different divisions, that nylon fiber division is actually outperforming the other 2 divisions. When I look at this 32%, which is the net operating income or segment margin over assets, what this is basically telling me is that for every dollar I invested in an asset, I'm earning 32 cents in net income, right? My net income is 32% of my asset or my segment margin here. So nylon fibers division is actually doing a good job choosing assets that are generating a good net income. Okay, so what we're going to look at next is the DuPont model. So what DuPont did was they took that evaluation and they wanted to use this now to evaluate their segments of the business. So what they did is that they decided that they could break this down and get more information than just net operating income over assets. So what DuPont did was they said, we're going to look at return on investment as margin times turnover. So margin is your net income divided by sales. Turnover is your sales over operating assets. And you can see if you multiply these 2 ratios together, then you're going to see your sales revenue is going to get canceled out here. So basically it is the same original evaluation, except we're going to get much more information out of it than just operating income divided by average operating assets. What we're going to get from this now is how to make improvements here, right? Which is what we're trying to do. And as a financial statement reader, then it is also going to tell you how management is going about getting the changes or the increases in ROI. So this really is so good when you're trying to actually get more detail out of just that ROI 32% that nylon fibers is earning. All right, so let's take a look at what margin is. So first of all, margin is another ratio, and that's looking at how much of your sales revenue now ends up as net income. So think about your income statement. You're thinking about your sales dollars, how many of those dollars end up as net income? So we're looking at how many of them are eaten up by expenses and then how much remains as profit. If you're looking at turnover, then you're looking at how well your assets are doing generating sales now, right? So you're looking at not net income, but generating sales. Okay. So let's put the numbers to this for nylon fiber division. So instead of just taking the segment margin and dividing by assets, now I can calculate margin, I can calculate turnover, multiply the 2 together, and I still get the same ROI. But like I said, I'm going to get much more information than just my assets are earning 32 cents in net income. So again, if I'm calculating margin, and I'm looking at my net income in relation to sales, I'm getting 10% here. What that means is that 10% or 10 cents on every sales dollar ends up as net income, right? Similar to what we just said before. If this is 10%, your net income or your segment margin is 10% of your sales. And then when I look at turnover and I'm getting 3.2, this generally means for every dollar in assets that I am investing, I'm getting $3.20 in sales, or 3.2 times the assets that I invest in are giving me sales. Okay. All right, more information. Why is this important to me? Because if I want to know how to improve my ROI, now I have more than just increase your net income or decrease your assets. So I know when I'm looking at this equation now, just mathematically, I know that if I increase my sales, or actually I should just say increase numerator, decrease denominator will give you a higher number, right? Just mathematically, that's how it works. So if I increase my sales, then I will increase my net operating income. These sales are pretty much canceling each other out. But if I increase sales, I know that that's going to bump up my net operating income. I also know that if I reduce my expenses, then that will also increase my net income. So that will increase my margin. If I look over here, if I reduce my assets, reduce my denominator, then I am going to also bump up my turns or and then again, my ROI. All right, so mathematically, I can figure that out. So how would you turn this into how do we make improvements? Well, if I am going to think about the ratios that you learned in 221, you've already learned ways of doing both. And what I'm showing you here is when you're going to make improvements in your ROI, you tend to focus on either margin or turnover, right? Generally, you can't do both. So if you are focusing on margin, getting more of your sales dollars into net income, then you're going to be trying to control your expenses better. So I know you did gross margin percentage or cost of goods sold percent or selling and general administrative expense. When you look at that percentage, it's a percentage of sales, right? Every time you look at an expense, you are comparing it to your sales number, just like we did contribution margin ratio. All of your expenses are compared to sales so that you can monitor your product costs and your period costs and make sure that you are keeping control of your expenses. So that's what I'd be looking for if I'm trying to figure out or increase my profit margin, getting more of my sales dollars into net income by controlling my expenses better. Or if I'm looking at asset turnover, remember you're trying to streamline your assets. You want that denominator to be lower. So what you can do is, and this is really the way that companies focus on this, is turning over your inventory. You can turn over, the quicker you can turn over your inventory, you're going to generate your sales that way, right? So if you can sell more, turn on that inventory, you're going to keep your inventories low and you'll generate a lot of sales. But in addition to that, make sure that your accounts receivables are being collected, right? I know you looked at average days it took to collect your receivables or how many times a year you collected your receivables. I'd be focusing on that if I'm trying to focus on my turnover, keeping my assets streamlined. Also, in terms of keeping your assets, we talked about outsourcing. That would be a way to keep your asset down and still generate a lot of sales, right? So that's another way that companies get ROI, or just moving to a just-in-time inventory. Again, keeping the inventory low. Inventory is a big asset, current asset. That is another way to improve that turnover or to streamline your assets. Okay, so as I said, managers tend to focus on one or the other. And when you look at the margin and turnover of two different divisions, it's going to help you look at the strategy of which one or which method each one is using. So if you're focusing on the profit margin ratio, then what you're probably focusing on is differentiation strategy. So what that means is you are differentiating yourself from your competitors and able to charge a higher price. So think Tiffany's here. So Tiffany's is a jewelry store and they charge 10 times the price that a regular jewelry store would charge. But they have convinced their customers that because they're buying from Tiffany's, it's worth it to pay that extra money. So they have differentiated themselves, and because of that, they're selling at a higher price. So they're getting more in their net income. And that's their strategy of getting the return on their assets up. Right? If you are somebody that's focusing on asset turnover, then think Walmart. So Walmart is not going to charge a high price. In fact, it's just the opposite. They focus on low prices, and the way they generate their sales is through volume. They sell their inventory by the pallets as they come out of the store, right onto the floor. And so if you are somebody like Walmart, you're not going to have high profit margins. You're selling at a very low price. And so you don't have a lot of sales getting into net income, but you do have that turnover generating your sales. So it's two different strategies. And when you are analyzing a company, when you break it down into margin times turnover, you get to see which strategy is used and which one is working and which one is not working. Okay. So what do you think? Here's firm 1 and here's firm 2. You have a little bit of money and you're thinking about investing here. Which one would you want to invest in? Firm 1 or firm 2?
Maybe firm 2 because the profit margin is 10%, so they are earning their net profits are much more on the sales revenue that they are incurring, and like their asset turnover ratio is 0.5, which means that like they're using more assets. But like it's the same situation, but like I feel that like since they're earning more margins, they are more efficient, maybe.
Okay, well, both are, I mean, so both are going to cause margin and turnover, cause your ROI to go up, right? Anybody else want to comment on this? Erica?
I don't know if this is right, but maybe because the margin's higher, that like between like net operating income and sales revenue, like there's like a higher profit. So that would be better for firm 2.
Okay. Quentin?
I was just gonna say for firm 2, the turnover of 0.5 does seem pretty low. Usually, I feel like if below 1 is not really normal, because that means for every dollar you put in assets, you get half a dollar in revenue, which sounds not profitable.
Okay, well, every kind of company is different, but what you're looking at here, this is a little tricky, because look at the ROA or ROI. They're exactly the same. So when you look at margin and you look at turnover, that's just basically telling you the strategy of how they're going about getting the return on their assets. So what I'm looking at is firm 1 and firm 2 getting the exact same results, right? So you're getting the same 5% return on your asset or return on investment. You're just looking at different strategies on how they went about getting it. If you are firm 2 and you're getting 10 cents from every sales dollar into your net income, that's probably a differentiation strategy and you are selling for a higher price. And as I said, if you sell at a higher price, you're not going to sell as many, right? So how do you decide high price, low volume? Or in this case here, you can see it looks like lower price, but then you get a higher volume because you're selling more of them. So in this case, it was sort of a trick question because the final result is exactly the same with just two different strategies here. Okay. Does that make sense? Okay, so here's the problem with ROI. Managers evaluated on ROI may reject profitable investment opportunities. We started off with this chapter talking about the advantages and disadvantages of decentralized companies. And the big disadvantage is goal congruence. As soon as you have a division that is acting as a standalone division, like looking at ROI and saying, if your ROI is this, then you're doing a good job or not a good job, then what happens is that division tends to start to fight their own number. They stop doing what's good for the company as a whole, and they start to look at only what's good for that particular division. So what I'm saying here is the nylon fibers division, we already just calculated that, has a 32% return on investment. They were the best performing division, right? So well above the corporate goal of 15%. So the CEO of Centex Yarn has told all three of the divisions that we require a 15% return on the assets. We want you to make investments in anything that comes in 15% or more. So then here comes this project, and it's going to bring in a 25% return on that investment. And so if you are nylon fiber division VP and you're looking at where you are now and looking at that possible investment, you're probably going to reject it because it's going to make your division number go down. But does corporate want you to do it? Yes, it would be good for the overall corporation, but you are not looking at that. There's no goal congruence here. You're fighting your own division number. Okay, so which is going to bring us to residual income and economic value added evaluations. So residual income and economic value added are different ways of evaluating segments of the business. I'll tell you right now, ROI is the one that is most generally used, but these are alternatives. And what they're going to do for you is make that goal congruence happen. Okay, so let's start with residual income. So residual income is companies typically have that minimum return that they require on asset investments. You know that the CEO of Centex Yarn is telling all the divisions 15% is the minimum return that we want you to make on your investments. With residual income, any income that is earned in excess of that minimum is called your residual income. And if that number is positive or an investment decision will make that residual income go up, then you're going to be looking at a favorable performance evaluation. So let me show you the calculation. So basically, residual income starts here. Here's your minimum required rate of return. For Yarn Centex, it is 15%. The average operating assets are multiplied by that minimum 15%, and that is the minimum net income, net operating income that you need to bring in. If your assets are generating an operating income of 15%, then your residual income will be 0. But if your current net income exceeds the minimum, that means that your assets are incurring or earning more than 15%. Anything that comes in is going to be looked at as a favorable performance evaluation. So think about it. Now, if I'm evaluating nylon division based on residual income, I'm not going to reject that 25% asset return because 25% is going to bump up my net operating income and it will bump up my residual income. So you don't fight your own number. You are looking at where you are now and how that will increase the residual income. Okay. We ready to put some numbers to this? Okay, so here's the residual income for the nylon fibers division. Again, here are the assets. Here's the required rate of return, which is 15%. So the company as a whole is telling the division, we want you to invest in 15% and above. And if you do, this is your minimum required net income. And it is $405,450. If you remember, the net income, or this is segment margin, because we're evaluating the segment, is $865,000. So I'm comparing what I need to bring in versus what I did bring in. And this is a positive residual income, so it would be looked at favorably. And of course it's positive because we already know that they're earning 32%, right? So we've already calculated ROI, and I know that if that is well beyond the 15%. Yep.
You could just do the difference in percentages and then multiply by the segment budget, right?
The difference in percentage.
So like 32 minus 15 and multiply that by the segment budget.
Okay. Yep. Yep. Okay. Okay, so residual income is going to encourage goal congruence, right? Instead of a division fighting its own number and not really thinking about what's good for the company as a whole, that 15%, then if you are evaluated based on residual income, then you are going to be working towards the company as a whole, their goals. But there's a reason why residual income is not used all the time. As I just said, ROI is generally what companies use to evaluate different divisions. So the problem with residual income is that if you are a big division, you have big numbers and you have big residual income. It's looking at dollars, right? If you are a small division and have small assets and small net income, then you have small dollars and smaller residual income. Just because you're a small division doesn't mean that you aren't performing better. So the problem with large divisions and smaller divisions, you cannot use ROI, residual income to compare two different size divisions, which is why it is not widely used, right? ROI doesn't have any dollars. It's that rate of return. It's shown as a percentage. So it's that common size percentage that allows you to compare two different divisions of different sizes to see which division is doing a better job returning income from assets. Okay. So as I said, in sum, when comparing the performance of multiple divisions, ROI is a better performance measurement since it's a relative measure and therefore it is used more widely. But when evaluating a single division, if you want to look at a single division and you want to make sure that they have goal congruence, then you could use the residual income method. And that way, anything that comes in above that 15% is going to be looked at favorably. Okay. Make sense? Okay, let's do some problems. All right, so here we have two divisions. We have Osaka and Yokohama division. I'm giving you sales, I'm giving you net operating income, and I'm giving you average operating assets. For each division, let's just start with number one. Compute the return on investment in terms of margin times turnover, and then where necessary, carry the computations to 2 decimal points. So we're going to start off with, we use ROI as our performance measure, and I want to know which division is performing better. Let me know when you think you have a decision. You guys all just pretending to work and just really doodling on your paper? It really looks like they're working. Is everybody working hard? Okay, anybody have numbers? What'd you get, Annika? Yep. Okay, so 21 for Osaka and 18 for Yokohama. What, are you guys all afraid that you made a math error and you didn't want to Okay, so that is exactly right. So the correct answer is 21 and 18%. So broken down into margin times turnover, I know that ROI, the Okasaka division, is the better performing. I'm getting 21 cents from every asset dollar invested versus 18 cents. If I go into margin times turnover, then I get to see the strategy. So it looks like the strategy of Osaka is working, right? So it looks like they're focusing on turns rather than margin, higher turnover, lower selling price, and that seems to be working better for this division. For this division here, they're performing okay, because remember, I don't know if you read it, the required rate of return is 15%. So both of them are performing above the required rate of return, but ROI is higher for Osaka.
How do you know that a lower margin means a higher low selling price?
It doesn't. So there's all kinds of things. It could be not controlling your expenses. Right, right. Okay. So let's do number 2 now. Assume that the company evaluates performance using residual income, and the minimum required rate is 15%. What's the residual income for each division? Oh, Brian, you've been hard at work. Oh, see everybody, now you're getting into it. All right, Brian, what did you get for Osaka?
I got 60,000 for Osaka.
Okay, and what'd you get for Erica? What'd you get for Yokohama?
I only did Osaka, but I
Oh,
can do Yokohama.
weren't you already in there already? What did you get?
120K.
120. Okay. Okay, so if I'm looking at my net income, I'm comparing that to my minimum required rate of return, which is 15%, and I'm multiplying that by my assets, right? So if my assets for Osaka are $1 million, and I'm required to bring in a return of 15% on those assets, then I need to have minimum net operating income of 150, but it is 210. So I'm looking at 60,000 residual income and 120,000 for Yokohama. All right, which division is performing better?
I think like Osaka is performing better because the residual income, like it's 6%, like it's 6% of 6%, and for Yokohama it's like 3%. So like they're like saving more.
Okay, so what the point I'm trying to get at is you cannot use residual income. So you're trying to get percentages of residual income, looking at percentages of assets, and right. So you don't have to do that because you already have this. Right, so if you want to compare 2 different divisions, you have to use ROI. When you look at residual income, that's fine to look at Yokohama and compare that one division, but you can't use residual income and compare 2 divisions of 2 different sizes. Look how much bigger Yokohama is, right? It has way more assets, way more net income, and just because it's bigger, the dollar value of residual income is higher. So this does not mean Yokohama is better performing, because you can see right here that they're earning 18 cents for every asset invested versus 21. ROI is what you need to use when you're comparing 2 divisions. Okay, are we good? Okay, so I didn't trick anybody. I wanted somebody to say, oh, it must be Yokohama, but you know that you can't use residual income to compare different divisions. Okay, so let's do another problem. So here again, I'm asking you to calculate the return on investment for each of the 3 divisions and calculate the residual income. This time, I'm not going to have you do all the numbers because I know now you've just practiced it. So instead, we're going to make it a theory question. So I'll show you the results of ROI and residual income. And then here's the question that I'm asking. Assume that each division is presented with an investment opportunity that would yield a 15% return. If the performance is being measured by ROI, which division or divisions would probably accept the opportunity, reject it, and why? And if the performance is being measured by residual income, which division or divisions will probably accept the opportunity or reject it, and why? Okay, so here's the ROI computations broken down into margin times turnover. So here, division A is the better performing division. And what I'm asking you is, if division A is evaluated solely on ROI and there's an investment opportunity that comes in and it is, 15%, will division A accept or reject it? Reject it, why? Right, it would make that 20% go down, right? If you are fighting your own division number, you don't care what's good for the company as a whole. You care about only what's good for your division. And I'm looking for, if that's true, investments that are 20% or higher. Does the company want them to accept this? Minimum rate of return, 14%. Okay. So if I'm going to evaluate division A based on residual income, would I accept it? Yes, because I'm going to see my residual income go up, right? So if I am looking at residual income as my performance evaluation, there's more goal congruence here. Now I'm not fighting what is good for my division. What I'm doing is I'm looking at the company and doing what is good for the overall company here. Anything that comes in above 14% is what corporate is telling me is a good investment, and the investment is 15, so it would bump up my residual income. What about division B? Division B has an ROI of 8%. Natalia?
They would accept it.
Okay, they would, because 15 would make 8% go up. If I'm looking at residual income, division B's required rate of return is 10%. So if a 15% opportunity comes for division B, are they going to accept it? Are you saying no, Erica? Why are you saying no?
Is it because the minimum required rate is like 10% and that's lower than that, or?
All right, so it requires 10, but this asset is 15. So that would cause, so poor division B is not performing well, right? If you look at what they're required to bring in, they're telling them 10% is the required rate of return. They're only at 8, which is why they're showing a negative residual income. So they're not even earning their required rate of return. So if an investment opportunity of 15% comes along, I'm going to grab it. It will make my ROI go up. Or if I'm looking at residual income, anything that comes in above 10% makes it go up. So it is a yes on all accounts for division B. It would increase ROI. It would increase residual income. What about division C? Denise, I miss you.
I missed you too, Miss Asadoorian. I'm sick. I would come in person, but
You're still sick?
I got mono after Rona, so.
Oh, okay, well, you are a trooper then. So what do you think about division C?
I don't think they would take it because their minimum required rate of return is already 16% and their ROI is 16.
Right, all across the board, it's a no-go for division C. 15% return would make this 16 go down, and a 15% return would make this a negative residual income. So you can see right here, when your required rate of return is exactly what you're earning, then you don't have any residual income. You're looking for a positive residual income because that will mean that your investments are coming in above 16%. Okay. Redmond Awnings, a division of Wrap-Up Corp., has a net operating income of 60,000 and average operating assets of 300,000. The required rate of return for the company is 15%. What is the division's ROI? I'm going for 100% here. We don't have many days left. Okay, I'm going to give you 10 more seconds. Okay, I'm going to close it out. We'll see how you did. Okay, 83% of you have the correct answer, which is 20%. So this is how you fell in relation to everybody else. So not 100%. So let's figure out how we're getting 20%. So if I'm looking return on investment or return on asset, I'm looking at my net income, operating income, and divided by my average operating assets. So right now, this company has a return on their assets or return on investment of 20%. Right, keep that in your head because now I'm going to ask you more questions here. Is everybody good with this first before I move on? Same information, same net operating income, same assets, average operating assets. If the manager of the division is evaluated based on ROI, will she want to make an investment of 100,000 that would generate an additional net operating income of 18,000 per year? Quentin, why?
Because that would be an 18% ratio.
Okay, so what Quentin is looking at is this investment is going to be $100,000 out for assets, and it's going to bring in 18,000. That's a nice, easy math calculation of an 18% return. And if we are at 20, then that will cause my ROI to go down. Can you calculate what our ROI will be? Yes, you can. If you're getting an extra 18,000 in operating income, I can add that to my 60. And if this investment is an asset that's $100,000, I can add that 100,000 to my 300. And I can see that, yes, it is making my ROI go down. It would go from 20 to 19.5 because this investment only brings in 18%. AJ.
The ROI one, but like you wouldn't take on that investment even though you just would make 18% on it. I don't understand why they would take it on.
Well, so the whole idea is goal congruence here, right? So if you're this division and you're evaluated based on your ROI and you're at 20%, what happens is you stop listening to what the overall, what's good for the overall company, and you start doing what's good for your division. And I'm looking to increase ROI, and that would mean that I'm looking for any investment that is 20% or above. But the company's required rate of return is 15%. Would the company want the manager of Redmond Awnings division to make an investment of 100,000 that would generate 18? Yes, they do. That's the problem. There's no goal congruence here. This division is acting on its own for what's good for that division, right? So the answer is yes, because 18% exceeds the minimum 15%. This would cause your residual income to go up. which is going to be my next question. Yep.
So would they call them up and be like, you have to do this?
Well, no, the idea is you're supposed to be decentralized. I can't focus on you. I'm trying to look at the overall strategy of the company. But at performance evaluation time, I'm going to look at your ROI. At performance evaluation time, I'm going to look at your residual income.
What if the company has a thing where the division with the highest net income, like the manager with the highest net income gets it, like would the manager be willing to accept the opportunity then if it's over the required rate of return?
Well, so again, bigger divisions have bigger numbers. So, right, which is why you can't look at the numbers, which is why ROI works, because it's a percentage. All right, so what's the division's residual income here? Okay, 10 more seconds. I can tell who did the hard work when I made you calculate ROI, residual income, and who sat and said, I'm not doing it. I'll just wait until I get the answer. Okay, I'm going to close it out. Let's see how you did. Residual income. Okay, 83% of you had 15,000, which is the correct answer. So how do you get residual income? Your required rate of return is 15% and your assets are 300,000. You are required to bring in a net operating income of 45,000. Your net operating income is 60. So your residual income is positive and it is $15,000. Okay. Everybody good with the numbers? If the manager of the Redmond Awnings division is evaluated based on residual income, will she want to make an investment of 100,000 that would generate additional operating income of 18,000 per year? Required rate of return is 15. Okay, you have a 50-50 shot. Anybody on Zoom want to answer? Stephanie?
Is the answer yes?
Yes. The answer is yes, because an 18% return exceeds 15%. It should make your net, not your net outcome. It should, well, it will make your net income go up, but it should make your residual income go up. And if you want to see how much, again, if you want, you can recalculate this, right? You can say 15, 18 for a yes or no here. But if you want, you can say this investment would cause my net income or operating income to be 78. My required rate of return would be 15% now on 400,000 of assets. And you can see that your residual income is positive, but more positive. Any investment that comes in above that 15% is going to cause your residual income to go up. And if you're evaluated based on residual income, this would be a positive performance evaluation. So we would have rejected it if we used ROI. We would accept it if we used residual income. But why do we usually use ROI? Why is that widely known as the way we evaluate segments? Right, because you want to be able to compare your different divisions and you can't do that with residual income. Okay, sorry, I ran a little bit over, but there's no transfer pricing on Monday. We're going to finish this up with economic value added, and then I have a really good, cool thing to do on Monday. You're either going to hate me or you're going to love me, but I'm excited about it.
Thank you.
Yeah, I'll see you Monday.
Thank you.
The other sections still have their case, that second case to do. Oh. I know, I was thinking, oh, why would you leave that till the end when everybody has all those project papers? That being said, I have a project for you on Monday, but it'll be in class, so you don't have to worry about it.
Have a nice weekend.
Thank you too.